maximum credit score, 10% down. Anything below, 3.5% down. Anything below 580 becomes 10% down for FHA. Okay, and 580 and below kind of gets harder to approve. Now we're looking into why is your score 580? Sometimes it becomes a liability, right? Very, very flexible in guidelines. Like I said, I have a 45% front end ratio earlier, 46, and we were able to get AUS approval because her credit score looked great. It's just that the house that she's buying, property taxes, homeowner's insurance is a little bit higher, which put her front end ratio a little bit higher than normal, but she has no other debts, right? Very ideal for first-time home buyers, right? Down payment assistance, and now you can get a higher closing cost contribution from the seller, 6%, okay? And like I said, loan modification is a little bit easier when times get rough. Okay, next slide. Loan program, USDA loan, typically rural areas, basically 100% financing, right? No down payment. Same thing, pretty much. It's very flexible, 29% now on the front end ratio, 41% on the back end. Very, very low, right? So you have to be very good when it comes to your finances at that point. But as far as gift funds, it's basically the same as FHA loan. You have your VA loan, again, for veterans, 580 credit score, 0 down payment. It's all technically 100% financing. So the bank is not requiring you to put anything down. Kind of like FHA, 45% to 55% DTI. Difference is 4% maximum seller contribution. Okay, so, all right, next slide. Here's my favorite. I've been talking about this whole night. Down payment assistance program, right? Super easy to qualify. It's like snapping your finger for as long as you meet the requirements. If you don't meet the requirements, we'll work with you, and you will work with your clients if they don't meet the requirements. You will work with your clients if they don't meet the requirements. All right. Again, all it is regardless of how they tell you, is it a grant? Is it repayable? Is it a silent second lien? Right? It doesn't matter because there's no such thing as free money. Okay, you really want the grant? Well, you have a higher interest rate. You want the repayable? All it is that you're paying a second lien with your first lien each month. All right, there's no such thing as free money, or else life would be great, right? But repayable is typically the way to go, unless, again, the TSHAC program that I was telling you about earlier, this kind of like a nonprofit state of Texas program, where it's a 3-year forgivable and there's no payment, but you have to qualify for it. But I tell people, don't worry about it, because at the end of the day, the down payment assistance program is used to get you into a house sooner than later. Okay? Buy what you can afford. It can be for FHA or conventional. Again, conventional has higher interest rate. It's the only time I ever use a conventional loan for DPA is if the spouse has a lot, if they're not using the spouse as a co-borrower, and that spouse that's not being added onto the loan has a lot of debt, then we have to qualify the other person on her own or on his own without adding the spouse's debt to income ratio on top of hers. Because with FHA, common law in Texas, even if the spouse is not borrowing or is not added onto the loan, we have to pull their credit and add their debt to income ratio on top of whoever's borrowing. Make sense? Okay? So that's the only time I'll use the conventional loan, because really at that point it would not make sense. It would cost more. But yeah, pretty much the same as any other FHA or very similar to USDA or VA loan.
But the credit would not be determined. His credit, like in that scenario,
it wouldn't deter. It wouldn't. Yeah, it's just the debts. Right, that's right. The credit score would no longer matter for the one that's not borrowing. We just have to pull and add that debt to income ratio to the spouses. Okay. Next one, please. What kills the deal? 2-year work history. If working 2 jobs, we talked about this, right? It's all about consistency and stability. Right? It doesn't matter if you're working 2 jobs making good money. If you don't have history, we can't use it. Okay? Next slide. So here's the fun part. Okay, you were asking about how do we take over people's mortgages. So the first part of that segment, we were talking about the traditional way of buying a house. Banks. realtors, right? In real estate, there's a thing that we call creative financing. So creative financing is basically just like what it says. You can be creative with anything. Terms, it's all about terms. So one thing about creative financing is we have this thing called subject to, I'm just gonna shorten it, or let me just write it all down. Subject to financing. Subject to financing is when you simply take over somebody else's mortgage without a bank.
Is that like loan assumption?
No, so that's basically, I call that assuming loan. Okay,
Assuming loan.
I call it taking over somebody else's mortgage and assuming somebody's loan.
Okay.
Taking over somebody else's mortgage, there's no bank.
Okay.
Assuming somebody else's mortgage, there's a bank, and that loan gets transferred to your name.
Okay.
When you're taking over somebody else's mortgage, that loan stays under their name, or
Okay.
under the seller's name. So let's say you have a house right here, right? You have seller one, and then basically here's you. So when you take over somebody else's mortgage, loan stays here. Subject to financing is taking over somebody else's mortgage without the loan getting transferred to your name. There's no banks involved, but the title gets transferred to you. You are now the new owner. You take the responsibility of that home. You keep the terms. If they have a 5% interest rate, you get to keep that 5% interest rate. If they have a $2,000 monthly payment, you get to keep that $2,000 monthly payment. So the question would be, why would a seller sell a house that way? Well, what are you guys experiencing right now? Houses in new construction, no equity. People late on their payments. Or even if they do have equity, the house is sitting in the market for a long time. So that's where creative financing comes in. Not only for the seller, but for the buyers. What if you have a buyer that's making good income, but they can qualify traditionally because of credit score and they don't want to wait 1 year? What if you're working with a business owner that makes good income, but does a lot of write-offs, but they have savings? So this is where the creative financing comes in, where you can simply take over somebody else's mortgage and take over the terms that they have existing. Now, when it comes to doing this, there's obviously a fee, right? You have to be able to get the seller to agree to it. And then you have to pay their payments that they're behind on, right? You have to pay for attorney fee to get everything transferred legally. You have to pay for a title company. Everything is done just like a regular real estate. You have a wholesaler like us. We are the ones that found the deal for you, so we're gonna charge our fee. And let's say there's a listing agent involved in this one. Let's say you have a listing. Hey Joseph, I saw that you have a house. They don't have a lot of equity. Would the seller be open to selling the house subject to financing? Because I have a buyer, right? So now you educate your seller why it's okay to sell if they're comfortable with it, right? Because a lot of sellers are not comfortable with it is because, well, what if they stop paying my mortgage? The loan is still under my name, right? Well, as an investor, if you're putting money in it, so let's say you're behind 20 grand, I just paid 20 grand to get you caught up. So if I stop paying, not only did I prolong your foreclosure, you get to get the property back. And then in the last 6 months to a year, I just fixed your credit because I paid it.
So when you